Okay, what is the estate tax? Okay, let's add a little note over here. The estate tax, it's called a unified tax, which is the estate plus gift taxes, like that. So what does that mean? All right, let's simplify this because there's a lot of legal jargon and things like that. But when you are single, and I believe this number changes every year, but when you're single, your unified gift and estate tax, you have an exemption. Okay, if you're single, I believe it's somewhere around 13 million. It changes every year. Okay, if you're married, it's double that. Would it be what, 26 million as an exemption? Okay, are we getting that so far? So again, single, you have 13 million that you can give up to. That's why most people, the vast majority of the United States, the vast majority of us citizens are going to die well below this exemption, okay? It's only for those folks that are really valuing their net worth is over that 25, 26 million where you have to start paying estate taxes, okay? So what does that mean? So let's say, for example, my real estate is worth $50 million. I have commercial property, I have all of this stuff, this rental property that's worth a lot of money, okay? Well, I'm married, so my exemption, let's just round it up to 25 million. So what does that mean? It means that my assets that are subject to estate tax equals $25 million, okay? Let's think about that really quick. I'm worth 50 million. I'm married. So the IRS says, okay, we're going to give you an exemption, Stephen, for being married, okay? It's 25 million. If you die under 25 million, we don't care. You don't have to pay us anything. But if the fair market value of your stuff at death is over that 25 million, which it is, you're going to pay us 40% of that 25 million as a death tax. Isn't that crazy? You're going to pay 25 million, or sorry, you're going to pay 40% of that $25 million. Okay, I don't have a calculator here, but we can do a quick calculation. Okay, 25 mil times 0.4% is, we're going to write a check, our kids are going to write a check to the IRS for $10 million, which is pretty crazy if you think about that, right? So what do? We have this trust, Irrevocable Trust owns the holding company. We have all of these rental commercial properties. Well, we need to get this outside of our estate, okay? And what we're going to do here is we're going to draw a line. We're going to draw a line over here. And let me make this line a little bit bigger. Okay, what we're going to do here, we're going to add a little caption at the top over here, and we're going to say, this is inside our estate. Let me increase okay, this is inside our estate, which is subject to that 40%, and this is outside estate, okay? Now, here's what a lot of, I would say, fairly wealthy people do, is that they know that they're going to die with assets over 25 million. So what do people start doing? Okay, what do we start doing? Is we start to, well, we talk with an estate attorney, right? Because we don't do that. But you talk with a good estate attorney that understands the estate tax, okay? And you're going to look at some irrevocable trusts. Now, there's different flavors of irrevocable trusts. We'll talk about those here quickly. But we're going to have some known as idiots, right? We have some more charitably inclined irrevocable structures like CRTs and CLTs, like this, right? We have CRTs, CLTs. We have idiots, right? Maybe in this case, we have let's call it Cupert, right? But I really want to talk about the idiot and the CRT in this case, because maybe this client is charitably inclined and we can talk about the CRT, okay? So we have all of this stuff over here, all these rental properties, all this commercial property, and we know we're going to die with more than that 15 or $25 million in net worth because we're growing, we have a business that's growing, we have a lot of rental properties, maybe we're inheriting a lot of money, and we need to get stuff out of our estate, right? Remember, people who are joining in right now, we're talking about the estate and gift tax, how the really, really wealthy people have to get stuff outside of their estate to avoid the 40% tax on anything you give and anything your beneficiaries receive over a specific threshold, okay? So just to summarize, okay, let's look at our note here. Our real estate, here's the fact pattern. Our real estate's worth 50 million. We're married, so we get an exemption for 25 million. The IRS gives us that 25. I'm just rounding it up, people. So I know I'm not accurate on this number, changes every year. But our estate that is subject to the estate tax is 25 million. So we're going to pay 40% on this full estate if we do no estate tax planning, right? So that's why we're talking about these irrevocable structures and how a lot of people who are wealthy are push things or gift things or transfer ownership from their name outside, from inside their estate to outside their estate, okay?